Okay. Hey, thanks for your patience. Had a little interruption there. This is the final video, just kind of the evaluation of monetary policy, just a quick list. A few strengths and weaknesses of monetary policy. First, obviously one strength or advantage is that it's faster. Fiscal policy is slow. There are time lags, impact lags. Monetary policy is implemented like that. The chairman of the central bank will say, we're lowering interest rates. Boom, lower, end of story. Also, there's no politics. Because the central bank is somewhat independent of the government, there is no big debate on voting on what happened with interest rates. Instead, it is just a decision made by one person that's trying to achieve a target rate of inflation or promote other macroeconomic goals. Nextly, one kind of major disadvantage of fiscal policy is that there could be something called crowding out. With monetary policy, we don't get that here. No crowding out. Also, monetary policy, another good thing is that, if they are having trouble manipulating the interest rates or the target interest rate, they could just buy bonds or sell them until we get the target rate. It's nice that we have that malleability, so that it's how easily we can manipulate it. Those are strengths. Some weaknesses. One thing is that sometimes when they lower interest rates, hopefully to get out of a recession, sometimes consumers and investors don't really immediately respond. There's like a time lag there. It takes a while for them to start buying or lending more money and buying more goods and services or capital goods. So there could be a time lag in terms of response. Also, if there is a deep recession, monetary policy sometimes is not enough. I mean, if you think about it, if there's a big recession and the government's or the central bank's trying to get us out of that recession by lowering interest rates, we might, consumers and businesses, because they're worried about that big recession, might not actually borrow more money and buy more goods and services because we're too worried about the state of things that the interest rates just don't really respond. Next, and finally, sometimes when we lower or raise interest rates, it can impact other economic objectives. For example, we might cause stagflation, or we could impact the value of our currency by changing interest rates. For example, if we have a high interest rates, this might increase the demand for our currency because everybody wants to save in our country or buy our country's bonds, which would inflate the value of our currency. So anyway, just note, and we'll talk more about currencies next year, yeah. All right, so the strengths and weaknesses. Final weakness, and this is kind of a bonus question. I'd be really impressed if when you come to class, if you could tell me the final weakness. It's not listed. It's something called a liquidity trap. What is a liquidity trap? It relates to a weakness of monetary policy. So you want a bonus point? Tell me what a liquidity trap is when you walk in the door. All right. Hope this helps, and I hope you can now answer those questions of define monetary policy, what are the tools, what are the responsibilities, how does expansionary, contractionary monetary policy work, what does the shape of the curve matter, what are the strengths and weaknesses, which we just covered, and hopefully you can answer all the questions on your homework. All right. Have a great day. We'll see you soon. Bye.